Hello, everybody, and welcome. My name is Bennett Tchaikovsky, the accounting professor. Welcome to Managerial Accounting, Capital Investments, and Net Present Value. This is going to be our final question, at least for right now. Determine net present value, giving various alternatives. So just my quick disclaimer and copyright notice, the information and opinions in this presentation are mine, not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. This presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2024 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Presentations from time to time use information from third parties. Collectively, the third-party information is the property of those respective copyright holders, and the author does not make any claim to that third-party information. So let's go ahead and take a look over here at this particular question. So if you've been watching this series, the part one, which I'll link below, I spent a lot of time going through and explaining how present value works and how the tables work and why those tables are correct. So if you need a deeper explanation for that, I want to really encourage you to go through and watch that earlier video. But let's go over here and take a look at our next item up for bids. So we've got three different options. We have a existing piece of equipment that was originally purchased for $500,000. We used it for the last 8 years, and we're evaluating several opportunities to replace, rebuild our equipment. So we have option one, which is to repair the equipment. The repair will cost $110,000. Upon repair completion, the equipment would be used for another 5 years and will generate revenues of $100,000 per year. We'll have cash operating cost of $60,000. At the end of the 5 years, the equipment can be resold for $8,000. Next one we have is purchase new equipment. If the new equipment is a purchase, the cost will be $250,000. Existing equipment will be sold for $20,000. New equipment would generate about revenues of $100,000 per year. We'll have cash operating costs of $30,000 and last for 5 years. At the end of the 5 years, the equipment can be sold for $20,000. Sell the old equipment and lease new equipment. If the new equipment is leased, there will be required down payment of $60,000, and the existing equipment will be sold for $20,000. The newly leased equipment will generate revenue of $100,000 per year and have cash operating costs of $80,000 per year, including the lease payments, and will be held for 5 years. At the end of the equipment lease, the equipment will be returned to the lessor. I'm assuming a present value factor of 10%, compute the net present value for option 1, 2, and 3. Which option would we recommend? Please quantify our analysis. So let's go through and just talk about a few things that are common to this question. We do not care about the fact that the equipment cost us $500,000. That is not relevant for our decision making. That's what we call a sunk cost. So we have a couple options here. The first one is option 1, is we're going to repair the equipment. Now, what we want to try to do is we want to try to go through and kind of chart out the cash flows, right? Because what we're going to do is we're going to say, okay, what are each one of these different items bringing us? And we'll go from there. So in year 0, to repair the equipment, it will cost $110,000. And it's really like a refurbishment. To refurbish the equipment, cost is $110,000. Upon repair completion, the equipment will be used for another 5 years and will generate revenues of $100,000 per year. So income or revenue is going to be $100,000 each year, but my cash costs are going to be $60,000 each year. So the net income or the net cash revenue is going to be $40,000 per year. So when we go through and look at this, so over each of the next 5 years, this is going to be generating over here $100,000 per year. And this will be generating $60,000 per year, or of a net of $40,000 per year. Now, at the same time, the equipment can be resold at the end of 5 years for $8,000. So we have the salvage value And this is going to be over here at 8,000. Now, these cash flows here are not comparable to this amount. Why? Because we need a 10% rate of return on our investment. Present value factor of 10%. Same thing as we're requiring an investment return of 10%. So 40,000 5 years from now is not comparable to $40,000 today. So what I need to do is I'm going to need to go through and compute the net present value. How do I do that? Well, what I'm going to need to do is my net, we'll just call this like the net cash flow. I'm going to take the net cash flow of $40,000. Now, I have two options in terms of how to bring this back. I could use present value of $1, but I would have to do it 5 times, or I can use present value of an ordinary annuity of $1. And this over here is going to be 5 periods at 10%. Why do I know it's 10%? I'm being asked to use a present value factor of 10%. So we'll say something a little bit better. Okay, so got this over here. So again, assuming management requires a 10% rate of return on its investments. So I'm going to go present value of an ordinary annuity of $1, 5 periods at 10%. Why is it an annuity? It's the same amount each single year. We call it an annuity. So over here, 5 periods at 10% is 3.79079. So 3.79079, the present value of the net cash flow is going to be 40,000 times 3.79079, or 151,632. Now, for the salvage value, this is a one-time payment happening 5 years from now. So since this is a one-time payment, I'm going to use the present value of $1. 5 periods at 10%. Come over here, present value of $1. 5 periods, 10%. This is going to be 0.62092. So the present value of the salvage value is going to be 4,967. So my total cash or total present value of future inflows is going to be 156,599. So to get the net present value, my initial investment is going to be 110,000, right? So that's my initial investment. So my net present value is going to be the difference between these two, or 46,599. Okay, so that's my net present value. So we'll go ahead and put this down over here. We'll add it to the tally. So option 1, my net present value is 46,599. Again, if I'm going too fast for you, if these present value concepts are not making sense, go back and look at my T created problem 1. I will put a link to that in the video below. Okay, so let's go ahead and take a look now at option 2. And because we've done all this work, why not reuse it? Okay, I can sue myself. Okay, there we go. So for option 2, when I look at option 2, we're purchasing new equipment. If the new equipment is purchased, the cost will be $250,000. However, I can sell the existing equipment for 20. So the net outflow in year 0 is going to be $230,000. Now, and why is it this way? Why did we not get anything here? Well, in this case here, we were refurbishing it. Right, our cost to repair. Because if we're repairing it, we can't sell it. But in this case, we're selling it, we're buying new and trading the old one in. So coming over here, when I look at this, the new equipment will generate revenues of 100,000. So that's not changing. However, my cash operating costs will be 30,000 per year. So this is going to be 30,000 per year in operating costs, giving me a net cash flow of 70,000. Now the equipment can be sold for 20,000 at the end of the 5 years. So my net cash flow is now going to be 70,000 per year. My salvage value from option 2 is 20,000. So I'm able to get the equipment for 20. I'll be able to sell it for 20 grand at the end of the 5 years. So when I look at this over here in terms of my net present value, my initial investment is 230,000. So when I look at this over here, net cash flow is 70,000. 5 periods at 10%. Again, this is an annual amount. 5 periods at 10%. 5 periods, 10% is 3.79079, using the same exact factors, right? This is not going through and changing. Present value of $1, right? Over here for my salvage value, 5 periods at 10% is 6.62092. And so that's going to be 12,418. The total present value of the future inflows is 277,774. My initial investment is 230, so my net present value is 47,774. So go ahead and put this over here. And there we go. Okay. Now that's option 2. Let's take a look at option 3. Now with option 3, let's take a look at this. Sell old equipment and lease new equipment. So we're not going to own it. We're going to lease it. If the new equipment is leased, there will be a required down payment of 60,000 and the existing equipment will be sold for 20. Okay. So for option 3, I'm going to have to make a down payment of 60. And so my net outflow is here is going to be 40,000. My revenues are going to be the same. However, my cash operating costs are going to be $80,000, which includes the lease payment. Now, at the end of the equipment lease, the will be returned to the lessor. So there's going to be no salvage value. This is going to be a big zero because if I'm leasing it, I don't own it. I'm going to give it back to the lessor at the end of the operating lease. So let's go ahead and take a look over here. So for this option 3, my costs are 80,000 per year. Remember, this is costing me 60. So the existing for 20 and I have a net outflow for 40. So when I come over here, my annual net cash flow is 20,000, right? There's no salvage value. So again, it's the same factors. Present value of an annuity of $1, 5 periods at 10%. So once you come up with it once, you don't have to do it again. So now my net present value here is going to be 35,816. And now let's go through and talk about what's going on. Okay. So when I'm looking at this over here, right, between the difference between these 3, when a student is looking at this in terms of what would you recommend, oftentimes what the student will say is that, well, the option with the highest net present value is option 2. Option 2 is $1,175 higher than option 1. And option 2 is 11,958 higher than option 3. Okay. Now, what we could also go through and do in terms of further quantifying these Okay. We could say, well, 11,958, it's roughly about 33% higher. If I took this, multiplied it by 1.33, I would get roughly about that amount. This amount here is roughly about 2.5% higher. Lower than, that's probably not the best way to put it. But in any event, I think you kind of know. I'm actually okay if you're doing my test, you just say that. Now, that's one way to look at it, and you do not want to stop. What is the biggest issue with all three of these? Okay. However, the cash outlay for the three options is different. Option one has a net cash outlay of, so option one, or repairing it, is going to be over here, is going to be at 110. Option two has a net cash outlay of $230,000. Option three has a net cash outlay of $40,000. Now, this is a huge deal, right? And when we compare these two, right? If I'm really saying like over here, option basically over here, option one is 70,000 greater, has a greater. Option two has a 190,000 greater outlay than option three. So remember, don't just look at the number and say, let's do it. You have to go around and consider other factors. If I'm looking at option three, even though the net present value is lower than the highest one over here by 33%, I'm only risking 40 grand, right? As opposed to risking 230,000 just for that incremental gain in income. So you have to go through when you're looking at these options, and you have to look at everything. Now, could we go through and finance it? Sure, but that's really just kind of the same thing as leasing. But this is what we would say. So what would we say to management? Well, if management is looking for the greatest net present value, management would choose option two. If management is looking for the least amount of cash outlay, but with a 11,958 less net present value, then option three, leasing, would be the best option. And if you're taking my class, one of the things I'm really trying to teach my students is that when you're giving an explanation for anything, you always want to quantify it. You don't want to just say option two, highest NPV, right? Which option would you recommend? These are all three different. If management has a concern about the cash outlay, because remember, when we go through and do something like purchasing equipment, that's money we can't pay salaries with. So you have to be very, very mindful of other factors beyond just the highest net present value. And again, when we're going through and giving an analysis, we want to let the numbers do the talking. As managerial accountants, we're presenting the information. Hey, this is what it is. We try to bring in everything we possibly can into the discussion. But at the end of the day, it's up to the CEO of the company. And somebody was sharing with me about Amazon. And what Amazon would do is they would give their businesses about 3 years to make it if they were creating a new business. And at the end of those 3 years, they would either be making it or Mr. Bezos would have to step in back in the day and say, oh, no, we're going to basically keep going with this investment. And so when you're looking at creating a business, right, this is something that's really important. Now, for us as managerial accountants, we want to go through and compute the numbers, let the numbers do the talking, but we do want to take into consideration these nuances, which is one of them is how much cash am I going to have to put up front for this particular investment? So in any event, thank you for joining me here today. I look forward to seeing you on future videos. Greatly appreciate you watching, liking, and subscribing, all that other fun stuff. And I will see you on future videos. Have a great one.